Have you ever noticed how the wealthy seem almost relaxed about money? While most people are losing sleep over a surprise car repair, wealthy people are talking about their latest investment that might completely fail. While you're nervous about switching jobs, they're launching their third business. While everyone else is playing it safe, they seem to be taking wild risks left and right. But here's what nobody tells you about rich people and risk. They're not actually risk takers. Not in the way you think, anyway. Here at Simple Money, we've spent years analyzing how wealthy people actually think about money. And what we've discovered is going to flip everything you thought you knew about risk on its head. Because the difference between people who build wealth and people who stay broke isn't about being brave or reckless. It's about understanding what risk actually is. And I promise you, by the end of this video, you're going to see risk in a completely different way. A way that might actually change how you make every financial decision from here on out. Here's what's really happening. Most people think wealthy individuals take bigger risks. They see someone start a business and think, wow, they're so brave. I could never do that. That's too risky. They see someone invest in the stock market and think, what if they lose everything? That's gambling. They see someone quit their job to pursue something else and think, they must have a safety net I don't have. But here's the thing. You've got the entire concept backwards. Rich people aren't taking more risks than you. They're actually taking fewer risks. Way fewer. They've just redefined what the word risk actually means. See, most of us learned about risk the wrong way. We learned that risk means the chance something bad might happen. We learned that the safest path is the most predictable path. We learned that stability equals safety. And that might have been true for our parents or grandparents. But in today's world, that definition of risk is not just wrong, it's financially dangerous. Think about it this way. Imagine you're standing on an ice sheet. The ice looks solid. It's been solid for years. Everyone around you is standing on it, so it must be safe, right? That's how most people think about financial safety. The job that's been stable for 5 years feels safe. The savings account feels safe. Not investing feels safe. Staying in your comfort zone feels safe. But what if that ice sheet is actually melting underneath you? Slowly. Invisibly. And everyone's so busy congratulating themselves for playing it safe that nobody notices until it's too late. That's exactly what's happening to most people's finances right now. They think they're being safe, but they're actually taking the biggest risk of all. And they don't even know it. Let me explain the first way wealthy people think differently about risk. I call this the invisible risk trap. Here's what it is. Most people only see visible risks, the dramatic ones. Starting a business feels risky because you can imagine it failing. Investing feels risky because you can imagine losing money. Making a career change feels risky because you can imagine it not working out. But wealthy people? They see the invisible risks too. The risks that don't feel like risks at all. Not starting a business means you'll never own your time. That's a risk. Not investing means inflation is silently destroying your purchasing power. That's a risk. Not making a career change means you might spend 40 years in a job you hate, never reaching your potential. That's a massive risk. Here's why this matters. Your brain is wired to fear visible, immediate threats. That's evolution. If a tiger is chasing you, your brain screams, danger! But slow-moving, invisible threats, your brain just ignores them. So you see a friend start a business, and your brain says, risky. But you don't see your own purchasing power declining by 2 or 3% every year. You don't see the opportunity cost of not investing. You don't see the career stagnation. Let me give you a specific example. Meet Sarah. Sarah has $50,000 in a savings account. She's proud of this. She worked hard to save it. It feels safe sitting there. Her parents told her to save money, and she did. She feels responsible. But here's what Sarah doesn't realize. At 3% inflation, her $50,000 loses $1,500 of purchasing power every year. In 10 years, her $50,000 is worth about $37,000 in today's dollars. She thinks she's being safe, but she's actually guaranteeing she'll be poorer. Meanwhile, her friend Tom took $20,000 of his savings and invested it in a simple index fund. Yes, it goes up and down. Yes, that feels scary. But over 10 years, even with market crashes, his money is likely worth significantly more. Not because Tom is braver, but because Tom understood the invisible risk Sarah was taking. The wealthy understand this at their core. Every choice has a risk. Even the choice to do nothing. Especially the choice to do nothing. The second way wealthy people think about risk is what I call asymmetric betting. Now, this might sound complicated, but stay with me, because it's actually beautifully simple. Most people think about risk like this. If I do this thing, I might lose what I have. So they don't do it. They're focused entirely on the downside. Wealthy people think about risk like this. What's the maximum I could lose? And what's the maximum I could gain? And what's the probability of each? They're looking for situations where the potential gain is much, much bigger than the potential loss, where if they're wrong, they lose a little, but if they're right, they win big. This is why wealthy people start businesses. This is why they invest. This is why they take strategic career risks. Let's say you have an idea for a side business. You could start it for $5,000. If it completely fails, you lose $5,000. That's the downside. It would hurt, but it wouldn't destroy you. But if it works, even moderately, you could build something that generates an extra $2,000 a month. That's $24,000 a year. In 5 years, that's $120,000. Plus, you own an asset you could potentially sell. That's asymmetric. Small downside, massive upside. Now compare that to what most people do. They take a safe job that pays $40,000 a year. They'll make that exact amount whether they work hard or not, whether the company does well or not, whether they're there 5 years or 20 years. There's no upside, just a predictable, slowly inflating paycheck that might disappear anyway if the company has layoffs. Which one is actually riskier? Here's the thing. Wealthy people still lose sometimes. They start businesses that fail. They make investments that go to zero. They take chances that don't work out. But they've structured things so that when they lose small. And when they win big. Over time, you only need to be right once or twice to come out way ahead. Most people do the opposite. They risk everything for small, predictable returns. They put all their security in a job that could end tomorrow. They avoid any situation where they might lose, which means they also avoid any situation where they might really win. That's not being safe. That's being stuck. The third difference is what I call the control premium. Here's what wealthy people understand that most people miss. The riskiest thing you can do is put your financial future in someone else's hands. Think about a traditional job. Your income depends on your boss's mood, on your company's strategy, on the economy, on decisions made in boardrooms you'll never see. You have almost zero control. One day, someone you've never met decides to restructure, and suddenly, you're gone. The safe job that you built your entire life around? It evaporates. But we call that stable. We call that low risk. Why? Because it feels predictable day to day. Now think about someone who owns a business. Yes, their income might fluctuate. Yes, they face uncertainty. But they control the decisions. If something isn't working, they can change it. If they see an opportunity, they can take it. If they want to increase their income, they can work on growth. Wealthy people are willing to accept visible volatility in exchange for control. Most people accept hidden fragility in exchange for the feeling of stability. Here's a perfect example. During the pandemic, millions of people lost their jobs overnight. The safe career path turned out to be incredibly fragile. But people who had built their own businesses or had multiple income streams, they had options. They could adapt. They could pivot. I'm not saying everyone needs to quit their job. That's not the point. The point is understanding that giving up all control in exchange for a paycheck isn't as safe as it feels. The wealthy diversify control. Maybe they have a job, but they also have investments. Maybe they have a side business. Maybe they have skills that are valuable in multiple markets. They're not putting all their eggs in someone else's basket. And here's what makes this even more important. The world is changing faster than ever. AI is transforming entire industries. Remote work is reshaping careers. The skills that were valuable 10 years ago might be worthless 10 years from now. In that world, control is everything. The ability to adapt is everything. Relying entirely on someone else's system to take care of you? That's not just risky, that's terrifying. The fourth way wealthy people think about risk is through what I call the information advantage. Most people make financial decisions based on feelings, on what seems scary or safe, on what their parents did, on what their friends are doing. Wealthy people make decisions based on information, on data, on understanding how things actually work. And here's the crucial part. Once you understand how something works, it stops feeling risky. It just feels like math. Let me explain. Ask the average person about investing in the stock market, and they'll say it's risky. Why? Because they don't understand it. They hear stories about crashes. They see numbers go up and down. It feels like gambling. But ask someone who studied investing for 50 hours, who understands historical returns, diversification, compound interest, and volatility. They'll tell you the real risk is not investing. They've done the math. They understand that over long periods, diversified investing is one of the safest things you can do with money. The risk didn't change. The information did. This is why wealthy people invest in learning before they invest in anything else. They read. They study. They talk to people who've done what they want to do. They reduce uncertainty through knowledge. Here's what this looks like in practice. Let's say you're thinking about buying real estate as an investment. To most people, that sounds risky and complicated. What if you can't find tenants? What if something breaks? What if the market crashes? But someone who's spent time learning about real estate, they know how to calculate cash flow. They know what makes a good market. They know how to screen tenants. They know that even if the market drops, rental income keeps coming. They've reduced the uncertainty. They're not braver. They're more informed. And here's the beautiful part. Information is free now. You can learn almost anything online. The barrier isn't access, it's willingness. Most people would rather feel safe in their ignorance than feel temporarily uncomfortable while learning. Wealthy people do the opposite. They feel uncomfortable not knowing, so they learn. And learning transforms what seems risky into what's actually logical. The fifth and final way wealthy people think about risk is the long game perspective. Most people think about risk in terms of what could happen tomorrow, next month, next year. They're playing the short game. Wealthy people think about risk in terms of decades. They're playing the long game, and that completely changes the equation. Here's what I mean. In the short term, almost everything is risky. The stock market could crash next month. Your business might not make money this quarter. Your new career might start slow, but in the long term, the patterns become clear. The stock market has always gone up over 20-year periods. Good businesses compound. Skills develop. Investments grow. Short-term thinking makes you reactive and fearful. Long-term thinking makes you strategic and calm. Think about this. If you're trying to lose weight, eating healthy today feels like a sacrifice. But if you're thinking about the next 30 years of your life, eating healthy is the obvious choice. The framing changes everything. Same with money. Investing $1,000 this month might feel risky because that money could go down. But if you're thinking about the next 30 years, not investing is the risky choice. You're guaranteed to miss out on decades of compound growth. Here's a real scenario. You're 25 years old. You have $5,000 saved. You could keep it in savings where it feels safe but loses value to inflation. Or you could invest it. If you invest it and the market crashes next year, you might temporarily lose $2,000. That feels terrible in the moment. But if you leave it invested for 30 years, earning average market returns, that $5,000 becomes over $40,000. The risky choice makes you 8 times wealthier. The safe choice guarantees you stay poor. Wealthy people get this. They're comfortable with short-term volatility because they're focused on long-term outcomes. They know that time in the market beats timing the market. They know that building wealth is a marathon, not a sprint. Most people can't see past next month, so they make decisions that feel good now but devastate them later. They avoid discomfort today and guarantee struggle tomorrow. This is why wealthy people can seem so calm about money. They're not stressed about daily fluctuations. They're watching the long-term trend. And the long-term trend, if you're making good decisions, is always up. Now, here's what nobody wants to admit, and this might be uncomfortable to hear. The reason most people stay broke isn't because they don't work hard. It's not because they're not smart. It's not even because they don't have opportunities. It's because they're terrified of being uncomfortable. Think about it. Every single thing I just described requires some level of discomfort. Learning about investing is uncomfortable. Starting a business is uncomfortable. Making a career change is uncomfortable. Thinking 30 years ahead when you're struggling today is uncomfortable. And our brains are wired to avoid discomfort at all costs. So instead, we choose the comfortable risk, the slow decline, the invisible erosion. We choose the ice sheet that's melting under our feet because at least it feels solid right now. Wealthy people have trained themselves to be comfortable with a different kind of discomfort. The discomfort of uncertainty, the discomfort of learning, the discomfort of short-term volatility. And here's the really interesting part. Once you get comfortable with that discomfort, it stops being uncomfortable. It just becomes normal. Your first investment feels terrifying. Your 10th investment feels routine. Your first business idea feels impossible. Your third business feels logical. Your first career change feels like jumping off a cliff. Your second feels like an upgrade. The wealthy aren't special. They've just normalized a different kind of discomfort, one that leads to growth instead of stagnation. Let me tell you about Marcus. Marcus is 32 years old. He makes $60,000 a year at a stable corporate job. He's been there for 7 years. He has about $30,000 in savings sitting in a bank account, earning basically nothing. Marcus knows he should probably invest. He's read about it. His friends talk about it. But every time he thinks about actually doing it, he gets anxious. What if he picks the wrong stocks? What if the market crashes right after he invests? What if he loses his money? So he doesn't do it. He tells himself he's being responsible. He's waiting for the right time. He's playing it safe. Marcus also has an idea for a business. He's really good at graphic design, and several people have told him he should freelance on the side. He could probably make an extra $1,000 or $2,000 a month, but that feels risky. What if he can't find clients? What if he fails? What if people don't like his work, so he doesn't do it? He stays in his job. Same paycheck, same routine, same safety. 10 years go by. Marcus is now 42. He's still at the same company, now making $75,000 a year. His savings have grown to $50,000. He feels pretty good about that number. But here's what Marcus doesn't realize. In terms of purchasing power, his $50,000 is worth about $37,000 in the dollars from 10 years ago. He hasn't gotten ahead. He's fallen behind. Meanwhile, inflation has been eating into his salary. His rent has gone up. His car costs more. Everything costs more. But his income hasn't kept pace. And then one day, his company announces layoffs. Marcus is let go. That stable job he built his entire life around? Gone. Now he's 42, with no investment portfolio, no side income, no business, and no diversification. All his eggs were in one basket, the basket someone else was holding. Marcus thought he was playing it safe, but he was actually taking the biggest risk of all. Now let me tell you about Jennifer. Jennifer is also 32 years old. She also makes $60,000 a year. She also has about $30,000 saved. But Jennifer thinks about risk differently. She takes $10,000 of her savings and opens an investment account. She puts it in a simple, diversified index fund. Yes, she's nervous. Yes, she watches it go down the first month and feels sick. But she understands this is a 30-year play, not a 30-day play. She keeps adding money every month. $200, $300, whatever she can. Some months the account goes down, some months it goes up. She stops checking it daily and focuses on the long term. Jennifer also starts her graphic design business on the side. She doesn't quit her job. She just spends 10 hours a week building it. The first few months, she makes almost nothing. It's discouraging, but she keeps going. After a year, she's making an extra $1,000 a month. After 2 years, it's $2,000 a month. She reinvests some of that money into the business and into her investment account. 10 years go by. Jennifer is now 42. She's still at her job, now making $75,000 a year. But she also has her side business bringing in $3,000 a month. That's another $36,000 a year. Her investment account has grown to over $150,000. Not because she's a genius investor, just because she started, stayed consistent, and let compound interest do its thing. Then one day her company announces layoffs. Jennifer is let go. But Jennifer isn't panicked. She has multiple income streams. She has investments she can tap if needed. She has a business she can scale up. She has options. Within 3 months, she's transitioned her side business into her main income. She's actually making more money than before, and she's doing work she loves with complete control over her schedule. Jennifer took what looked like risks, but she actually built a fortress of financial security. Here's what most people don't realize. Marcus and Jennifer aren't different types of people. They don't have different personalities. Jennifer isn't naturally braver or smarter. The only difference is how they defined risk. Marcus defined risk as anything that might make me lose money or feel uncomfortable right now. So he avoided visible risks, and in doing so, he embraced invisible risks that slowly destroyed his financial future. Jennifer defined risk as anything that leaves me vulnerable with no control or options. So she embraced visible, manageable risks to avoid catastrophic, invisible risks. And that's the reframe that changes everything. Risk isn't about what feels scary. Risk is about what leaves you vulnerable. Risk is about what limits your options. Risk is about what you can't control. Once you understand that, everything flips. The stock market stops feeling risky and starts feeling like protection against inflation. Starting a business stops feeling reckless and starts feeling like buying back control. Learning new skills stops feeling like wasted time and starts feeling like insurance. The wealthy aren't risk takers. They're risk managers. They take small, calculated, controlled risks to avoid large, invisible, devastating ones. And here's the really empowering part. You can do this too. You don't need to be wealthy to start thinking this way. You just need to reframe what risk actually means. Start asking different questions. Not, what could I lose? But, what am I already losing by doing nothing? Not, what if this fails? But, what if this works? Not, is this scary? But, does this give me more control? That shift in perspective is worth more than any investment strategy or business plan. Because once you see risk correctly, your decisions become obvious. So, let's recap what we've covered today. The invisible risk trap. Every choice has a risk, even doing nothing. Especially doing nothing. Asymmetric betting. Look for situations where you can lose small but win big. The control premium. The riskiest thing is putting your future entirely in someone else's hands. The information advantage. What feels risky is usually just unfamiliar. Learn, and risk transforms into math. The long game perspective. Short-term volatility is normal. Long-term growth is what matters. These aren't complicated strategies. They're just different ways of seeing, different ways of thinking, different definitions of what risk actually means. And here's what I want you to understand. Being poor isn't a character flaw. Staying broke isn't a moral failing. These are just predictable patterns that happen when you define risk the wrong way. The question isn't whether you're smart enough or brave enough to build wealth. You are. The question is whether you're willing to reframe what risk actually means. To see the ice sheet melting beneath your feet. To take small, smart, strategic actions even when they feel uncomfortable. Because here's the truth that wealthy people know. The biggest risk isn't trying and failing. The biggest risk is never trying at all. It's playing it safe while the world changes around you. It's choosing comfort today and guaranteeing struggle tomorrow. So what risk are you taking right now that you don't even realize? And what small, uncomfortable action could you take this week to start thinking about risk differently? Those might be the most important questions you ask yourself all year.